Welcome to the Money Over 50 podcast, brought to you by Dallas Davison and Michael Hogue from Money Over 50 Financial Advisors. This information is general in nature and does not take into account your objectives, financial situation, or needs. Therefore, you should consider whether the information is appropriate for you and your personal circumstances. If you require personal advice, please contact Money Over 50 Financial Advisors. Here are your hosts, Dallas Davison and Michael Hogue.
Welcome to Money Over 50. Today, Michael, your topic, high watermarks are dangerous. I always like these topics where I think I know what the title means, but I'm sort of not sure, and I'm interested in coming along for the ride.
Thanks, Dallas. So, the whole point of today's podcast is there's a correlation between people that look more frequently at their superannuation balance are prone to panic, or they're prone to worry, even if they're not going to panic. No. Look, they're prone to filling their head up with things that they just shouldn't fill their head up with. They should fill it up with more fun things. Yes. so what? And you're probably listening and go, "What is this bloke talking about?" But what I'm talking about is we set an investment strategy with our clients in their superannuation fund. We set a funding plan, which is putting money into their superannuation. We have periodical meetings that tend to be every 6 months. Now, some people aren't interested in those meetings. They just say, "You guys handle everything, and
just tell me what I need to do.
Tell me what I need to do.
Tell me how much to put money in."
So some of those people only come in every 2 years. Yeah. So what happens over that period of time is volatility that they never see. Yeah. And usually what's happened over that period of time, it's a long enough period of time to iron out that volatility. Yeah. And what I'm talking about here is negative movements down in the prices of the great quality companies that they own. Over a period of time of 1 or 2 years, all of that's usually ironed out, plus the money they've been putting in has accumulated. So what tends to happen is that they see a straight line of the value of their superannuation up and to the right. There's other people that set the same plan for. It might be if you imagine another couple that are identical in dollars that they have, dollar investment strategy is identical, and the funding plan, what they're putting into it, is identical as well. In 2 years' time, they're going to be in the same position as the first person. But they look at it every day, or they look at it every week, or they look at it. So they're the people that are prone to panic. So what happened in mid-2022 is we saw a drop of about 16% in the price of Australian companies' share prices and average global company share prices as well. So what had happened, if you had $380,000 at the start of 2022, after that 16% drop, you had about $322,000. Yeah. And that was the story for a lot of people. So a lot of people had actually, and what I'm talking about with high watermarks are that they check, and all of a sudden they anchor
to that top
figure, which was $380,000. Yep. And what happens then is that when the price falls by 16%, which is a completely naturally occurring event, the value of that temporarily falls from 380,000 to 322,000. Their head is filled with, I've just lost a significant amount of money. Yes. Their head is filled with, I've just lost $58,000. Yep. That's what their frame of mind is. Now,
I just want to add to something, and maybe I don't know whether this is where you're going, but what I find really interesting is, you said those two different couples. The spoiler here is that they're often the same couple.
They're often the same couple.
So what happens is, and when they start working this plan with us, they're 52 and they plan to retire at 62. For the first 5 years of their retirement, you can't get them to look at their balance. You cannot. You couldn't pay them enough money to come in for your meeting, look at this. Now, I find that something about that last probably 2 years for me is that real trigger point for a lot of people where, even if they've been a client, they've been working the same plan for 8 years, they get 2 years out and they kind of go, oh, geez, I better start paying some attention here.
Yeah.
They know, and we've got all the numbers, we've got the runs on the board. You just need to keep working this plan, and this is where you came from over the last 8 years. And it's normally mind-blowing for people where they were and where they are now. What they actually start to do is go, right, I've got 2 years. Retirement feels much more real and much more visceral to me, and it's just right around the corner.
Yep.
I better start paying more attention to this. And invariably, and this is you hear the same sort of a variation of the same phrase, which is like in the last 2 years of retirement or in the first couple of years of their retirement, people go, geez, this is just so much more there's just so much going on, and it's so much more volatile than it's ever been. But you hear the same phrase every 2 years from a different crop of clients.
Yeah.
It doesn't matter whether it actually is any more volatile, or it doesn't matter whether it's actually nothing going on. You hear the same sort of story, and now obviously over time you get good at knowing, okay, this is coming. I'm going to start to prepare my clients for this thing. But it's amazing to me how that happens, and how it's actually completely, unhinged or removed from the reality of the situation. Like I've got really good clients that I've had for 6-7 years now that they retired a month later. Company prices dropped by 6%, which is, as we know, that's a sneeze. Like that is complete noise. That happens on average of probably once every couple of months.
Yeah.
And they go, well, this thing's way more volatile now. What's happened? Now that we've moved into a pension account, is it invested differently? You go, no, you're just actually paying attention to it.
You're paying attention, and you've got the most amount of money.
Yeah, you've got the most amount of money you've ever
which
had.
seems significant.
Yes. Yeah.
So if we wind back, so the story from 1st of January 2022 to the 17th of June 2022, so roughly over 6 months, the story was invested in the top 1,500 companies around the world. A $380,000 superannuation fund dropped to about $322,000.
Yep.
If I wind back 10 years, a mere 10 years, which is a very short time frame, the story is that I invested $100,000 into those largest 1,500 companies. I didn't put one more cent in over that period of time. Between the 17th of June 2012 and the 17th of June 2022, $100,000 turned into $322,000. And that's a fact.
Yeah.
So, in an extreme, the person that doesn't look at something for 10 years, they choose an investment strategy, they put their money in, they sit there, they're looking at that 10 years later and going, this is fantastic. I've just tripled my money.
Absolutely.
It's a 12.4% annual rate of return on average, compounded out. Where the high watermarks are dangerous is that the same results happen for the person that looked at it every day.
Yeah.
It's just that they're anchored to $380,000.
Yes.
So they're seeing, they're causing themselves all sorts of anguish because they're saying, I've just lost, tens of thousands of dollars here.
Not I've gained hundreds of.
Not I've gained, I've turned $100,000 into $322,000.
Yeah.
So we'll put for ASIC's purposes, we'll put what we're actually tracking here in the show notes. I won't bore you with the details here.
Yeah.
But it's effectively, we would say this is a risk-free rate of return. Our definition of risk is different to some people's. Our definition of risk is the chance of permanent loss. We would say that's a risk-free rate of return over that period of time. 100,000 turns into 322,000, an average rate of 12.4% per annum. Hey, that's about consistent with what the long-term averages are.
Yeah.
So it's not out of this world.
Yeah.
What is the fee that you pay for a fantastic average rate of return of 12.4% per annum? You pay the fee of volatility. And the volatility fee is that at times not only will the price fall back by 16%, sometimes the price will fall back by 33%.
Yeah.
Or if we're talking about the global financial crisis, sometimes the price will fall back by 57% for a period of time.
Yeah. It's really interesting to see, because I've obviously got the chart here in front of me. I'm looking at that, and I guess that's sort of now, as I look at this over the last 10 years, this lines up with, saying different cohorts of people either approaching in the last couple of years they're working on from the first couple of years of their retirement. There's sort of 1, 2, 3. This is sort of the fourth time over that 10 years where I've had people go, geez, this is volatile. Geez, this is going, it's going to go to zero. This is scary. This is so scary. And like I said, they're all just different. It's the same people. It's just at a time when it's more vivid and more front of mind for them. But like, you look at this, to get from 100, as you just said about that, paying the fee, to get from 100 to over 300, you went from 100 to, and it's not as neat as this in round figures, but you went from 100 to 200, and then you dropped to 180.
Yep.
So you had that drop, and that would have, if you were retiring right then, you would have been looking at that going, I've just lost that 20,000. Then you sort of went from 180 to 260, and then dropped from 260 to 230. And then you went from 230 up to 300,000. You went from 300 to 270 odd. So each of these drops, these other three drops throughout this 10 years, they're sort of only about that 10, 15%. And we know that is about the average. And you can look at it and go, well, it's about the average because that's what we're seeing all the time. This is just par for the course. But that's, I guess, the point of, where they're dangerous, or where those high watermarks are dangerous. What you're talking about there is, it's not to say that it's dangerous because if you invest at a certain time, you'll lose money and it'll never come back. It's that you will anchor at that high watermark. You will think that there's something inherently about my super balance that it got to 380,000, therefore it should never go backwards from there. And what you're saying is that's a completely artificial point to
it's a completely artificial point. And I heard a lot of this in the global financial crisis because everyone's heard these stories. People retired before the market fell and they had to go back to work.
Yeah.
Well, they didn't necessarily have to go back to work. They measured the highest point that their superannuation was valued at, which, looking backwards, was too high. It should have never got that high at that stage because of the fact that the markets grew, which they do at times, a lot faster than they should. Yeah. They anchored to that point. They retired, and then they looked again when it dropped by 20%, and they looked again when it dropped by 30%, and then they looked again when it dropped by 57%. Yeah. Some of them made the catastrophic mistake. In fact, a lot of them did at that point in time of actually selling at that point in time. So their $1 million turned into $430,000 temporarily. With that 57% drop, they couldn't hack it anymore. They sold and they moved that money to cash or term deposits or bonds or whatever it was, and they never got back in. So they crystallized that loss. So
it's an interesting one. So I mean, like in those years running up to that big drop, there was returns of 25-30% year on year.
Yeah. So again, ASIC don't hold me to this, but the way that I remember it was that there was about 4 or 5 years of 20% plus returns. So. 2007, 2006, 2005, 2004 were all big returns.
And it's an interesting one because if someone came from 2004, if someone projected out average rates of return of 8% over, they probably would have looked at it and gone, right, I've got to work for another 10 years. Then after 4 years of an absolute boom, so I guess what I mean is you never hear the corresponding story, which is someone saying, I thought I had to work for 10 years. After 4 years, I'd reached my retirement target, so I retired 6 years early.
That's actually, most of those stories go like that.
Yeah,
so
like the reality is
we retired because we got to where we needed to be years and years earlier.
Yes.
So we thought we'll retire now.
Yep.
Really, it was a false. It was a false balance. Effectively, it should have never been at that level.
But you go like that's. It's in reality for some of those people, and it would have been a thing of I thought I had to work for 10 years. I worked for 4 years. I quit my job. The GFC hit. I had to go back to work for 3 years. after 3 years, I could, like, I've still, this is again the high watermark thing of, I thought I was going to work for 10 years. It turns out that I had to work for 7 years.
Yeah.
Instead of going, geez, my working life was 3 years shorter than I thought it would be.
Yeah.
It feels like it was 3 years longer because again, I've anchored to that thing of I'm retired. Okay, now I'm back at work for another 3 years. This is terrible. Instead of going, hey, I'm still 3 years short of what I've initially projected I'd be at.
Yeah. Yeah. I mean, I used to think it didn't matter if you looked while the markets were going up.
Yeah.
It only mattered if you looked when the markets were going down. So, but I've changed that.
Yeah.
I've changed that thought.
Yep.
It's not good to look
Either way.
too frequently either way.
Yep.
I mean, we have 6 monthly meetings with our clients. We feel that's too frequent to look at the value.
If there was a way to have those meetings without showing people their balance, that would be fantastic.
Yeah. So it's better than the alternative though, and some people are logging in every day to have a look at their balance and set those artificial high watermarks.
Yeah.
So
that would be that's not a crazy idea to say, right, we're going to have a 6 monthly review, but we're not going to look at your balance because it doesn't matter.
It doesn't matter.
You know what I mean?
No.
We're looking at this going, it does not matter what your balance is right now.
No.
For most people, like we said, we have meetings often in sort of June and May, June, and then November, December, so end of financial year, end of calendar year. You May, June, no one's, like a lot of the time people are working to the end of the calendar year anyway. So it doesn't sort of matter.
No, it's more that's our tax planning meeting.
Yeah.
So what we're talking about at that point in time, 9/10 of what we're speaking about is
making sure.
have you taken advantage of everything you can for this financial year from a tax planning point of view.
So that would be an interesting one to just have your May, June meeting go, we're not looking at the balance. We don't know what it is. We don't want to know. You don't want to know. We look at your balance, once a year in November, December, and then make a decision about, okay, how many more years on average will I have to work from this point? But it's an interesting point you say about, like, you used to think that it was okay to look when things are going up, and that's the danger. The dangerous thing is not what's the old saying about it's not the fall that kills you, it's the sudden stop at the other end. It's the same thing. You don't get hurt by the rise up, but what you do get hurt by is attaching to that point and that anchoring to that high water mark, and then the pain that you feel is geared towards that. Whereas if you just didn't have that to hang on to attach to, the as you've shown here, you have the same trip, you have the same journey, but you don't have that level of pain that person.
Yeah, same trip, same journey, same result. The person that fills their head with better things, like going on holidays or being productive at work or spending time with the kids or grandkids. Look, they have a much more enjoyable experience because they're not letting. It is distressing for people. It is distressing for people to see a drop. I mean, you and I, it's not distressing for us at all because we live and breathe it every single day. We understand the markets. People can understand in concept, yes, there will be volatility. I can accept a percentage drop. As soon as that percentage drop is applied over their superannuation balance, it turns into, for them, tens of thousands of dollars a drop, or in an extreme, it's $100,000 drop, or it's a $200,000 drop. That's the way that they're thinking of it, not in percentage terms. That's when it becomes distressing. So you're better off not looking as frequently as you do if you look frequently, and just sticking to your strategy. Our experience does, of course, is that the people that there's a high correlation between those that look less frequently make better decisions.
Absolutely.
And that better decision is sticking to the strategy. So because they're not looking, they're just sticking to the strategy. It's the people that tend to set these high watermarks, and they're the people that start to question the strategy.
And that's what I find really interesting. And I do have a lot of empathy for people in that last couple of years of working life, where, like we were saying, and it's a glib thing. It sounds glib to say to people, just don't look, because I know that is a hard thing to do. But what is fascinating to me is often, if someone became a client of mine a year out from retirement, I can see that would be really hard because they're sort of relying on a chart that I'm putting in front of them. Where I think this is really interesting is when you have those clients that you've had for 7, 8, 10 years, and in that last couple of years of retirement, you're not even saying, "Hey, act based on my on my advice or my say-so." Act on your own history. Like your own history shows that this is where you've come from, where you've got to. It's not just about, what do I think is going to happen. It's like this is something that has happened for you throughout this time. So that's, I think, the thing is having some empathy around going, we know that we know you shouldn't look. We know you're probably going to look to some degree, but just expect that if you do start to play that game, that is going to hurt, and you're signing yourself up for some pain.
Thank you for listening to the Money Over 50 podcast with Money Over 50 financial advisors. For more information and resources, visit the Money Over 50 website, mo50.com.au. We look forward to catching up again soon.